and welcome to our latest Insider interview. Today in the studio, I have with me Gervais Williams, who is fund manager of the Diverse Income Trust. Gervais, good to see you today.
Thank you very much for inviting me in.
So Gervais, to start off with, could you explain how Diverse Income Trust aims for both income and capital growth? How do you achieve both of those objectives?
Well, generally we pick a portfolio which is invested across all quoted companies in the UK, medium-sized, large companies and indeed some small companies and AIM stocks. And the purpose is to actually identify companies which generate more income growth than on most of the market. And if the income growth comes through, then that drags the share price up over time. Not every year, but over the longer term. And it's the capital appreciation along with the good and growing income which ultimately delivers the return.
When you're scanning the whole UK market for opportunities, are there key dividend characteristics that you're looking for?
No, I mean, the main thing we're looking for is a company which is set to generate abnormally large surplus cash. So this might be a mainstream mature company which has already done well. It's not growing particularly rapidly, but it's got a lot of cash flow coming through. Some of the insurance companies are yielding substantial and growing quite happily out of that. Many of the others are actually quite young businesses. They've just moved into a market, they've just finished a period of investment and the cash flow is coming through and they're able to grow their dividend fairly rapidly from quite a small level. And so the combination of both the big and the small, the local, the international, the mature, the less mature, it's all that mix and it's the mix which actually allows for the fund itself to come through uncertain times specifically.
And do you have like a minimum threshold for dividend yield? Or is dividend growth more important to you, or is it a mixture of the two? I
mean, some of the portfolio holdings are companies which aren't producing any income right now, but they're just set to produce a large surplus of cash. And so they'll be producing income in the coming year, the income next year. And therefore, it's not just the income, it's the income growth which we're looking for. And it's the combination of companies, as I say, which are largely mature, which don't grow their income very fast, along with younger businesses, which are now in a position, hopefully, to surprise in terms of the income growth.
And could you talk us through the current split in terms of company size? What percentage do you have in large caps, mid caps and small caps?
Yeah, the mix has actually been relatively consistent over the years. We've always had around 40%, a large part in the mainstream companies, that's in the largest companies, some of the mid 250s. It varies a bit. At the moment, there's a bit more of a bias towards the very largest companies, less 250 companies, but it's been other times slightly different. And then the remaining 60% invests in other companies. Around a third of the total fund is in AIM stocks, so 30-35% in AIM stocks. And many of the others are smaller quoted companies in the UK. The odd company which is on Aquis or something like that, but generally the kind of bias is towards smallness, but there's many mainstream companies in there as well.
And in terms of company size, is it the mid caps and the small caps where you're finding the best opportunities in terms of their valuations being low? And could you name a couple of stock examples?
Yeah, it's interesting actually. Even the mainstream companies are quite cheap. As you know, the US has outperformed enormously. It's been particularly this kind of what's called high beta companies which move up rapidly when the market's moving well, and obviously the markets have been very good over the last 10 and 20 years. So the UK market's actually underperformed. These are slower moving companies generating a lot of income. They're fairly safe, but nobody's wanted safety in the last 5 and 10 years. Particularly in the last 3 years, we've seen UK redemptions in the UK OIC, the open-ended investment companies, depress share prices. Large companies have been depressed, but they've bought back their shares. They've held up okay. And so there are some companies which are very lowly valued. I mentioned the insurance companies, but there's plenty of big companies out there which are, in our view, overlooked even in the mainstream market. But as you move down the market cap range, many of those companies have actually become not just overlooked, but what we can, perversely overlooked. Some of them, really, their valuations really are quite they appear sort of absurd in some cases, right? So one's been in the portfolio the last 2 or 3 years. Galliford, it's just reported its results. It's had a trading update today. The share price is doing fine. It's done very well, actually. It's outperformed. It's around a £400 million company. It's got a 2.9 billion order book, right? A construction business, don't get me wrong. Its market cap is, more than half the market cap is covered by cash. Ridiculous. Another company, perhaps, which came into the portfolio about 2 years ago, U Group, which is basically involved in utilities. It's a bit like sort of a small Centrica. It does particularly works in the corporate sector. It's growing its market share. It's grown its market share quite happily over the last 2 years. Grown its business. The share price over the last 3 or 4 years has actually risen faster than Nvidia. Right. And it's still, in our view, overlooked in valuation. It's got about between 1% and 2% market share now. Next 3 years, the analysts think perhaps 5%, maybe more. So this is a company which is generating very substantial surplus cash, only recently started paying dividends, and the dividend growth could be very exciting from here.
I read a recent commentary that you wrote in which you said that for a number of your holdings, if they were listed in the US, their share prices would be a lot higher than what they are in being listed in the UK. Could you explain the reasons why, and could you name some stock examples?
Another business which we've just reported today is called Concurrent. It's a technology business. It's a defence business. It actually puts sort of single-board computers into lots of ships and sort of armoured personnel carriers, that kind of thing. A lot of these upgrades are just improving the computing. It's very well run. It's just reported above expectations, 10% above expectations sales. But most particularly, this is a company where if they get lucky, they could sell very, very much more going forward. The share price has done very well. It's actually it's come up very nicely over the last 12 months. If it was a US quoted company, it would be worth so much more than it is here. Kind of ridiculous, but not a problem. We can invest in it, and that valuation comes through over time.
Many mid and small cap companies are reliant on the health of the consumer. Do you have a lot of exposure to stocks that are reliant on consumer spending? We
do have some consumer stocks, but not very many, to be fair. We don't actually think that's a very exciting area. Don't get me wrong, some good companies there, they generate cash, but many of them actually got some challenges. We're not sure whether the UK economy is going to grow well the next few years. We've got the extra cost increases from national insurance. Obviously, the minimum wage is coming through strongly. And so we are a bit unsure about some of those companies. So we then, do we have any house builders? No. I mean, they're nice companies, don't get me wrong. They're generating some cash, but no, we're very light in that area. We're much more involved in companies which actually have not just good growth, but good growth through resilient and uncertain times. And it's that which gets us excited at the moment.
You've mentioned you have around a third in AIM listed companies. Did any of the companies you hold benefit from the relief rally that happened following the budget at the end of last October, in which the inheritance tax sweetener for owning AIM shares became a little less sweet, but there were fears that it would be removed entirely?
Yeah, I mean, if anything, the AIM stocks have actually underperformed. If you look at the AIM market as a whole over the last 3 years, relative to perhaps the mainstream market, FTSE 100, there's a differential of 50%. It's underperformed by 50%. And this is not because they all have profit warnings. These are half-decent companies. Many of them are much better than that. Some of them actually surprised on the upside. And because capital's been withdrawn and not many of them are buying back their shares, some are. Galliford have started buying back their shares, but generally not many of them are. And their share prices have been really lost out. Don't get me wrong, we think the actual IHT has been brilliant. If you look around the world, there are not many markets which have a vast number of good small cap quoted companies. Lots of mid caps around the world, but the UK has a vast universe of small companies. Now that's great because their valuations can rise and they can succeed and they can grow more rapidly in the main market. It gets much, much more important if we get into global recession. If you find that some companies start to go bust, some of the zombie companies, for example, then if you've got a well-financed business, it can actually expand into the vacated market, accelerate earnings. And some companies can actually buy assets from the receiver, often for as little as £1. Yes, they have to put working capital in, but make transformational acquisitions. Don't get me wrong, some big companies can do that, but small companies, because the uplift is so substantial relative to their size, can generate transformational earnings. So the opportunity here isn't just to invest in companies which are different, which have a variety and new markets and all the rest of it, but actually have the opportunity to not just survive, but thrive in an uncertain world. That's what we're going to get excited about in the future. We think the UK specifically as a market won't just survive but thrive because of its good and growing income bias, but most particularly the smaller companies in the UK market will outperform not just the mainstream market in the UK, but the UK market will outperform most international markets. We are more bullish now than we've been for 30 years.
Gervais, thank you for your time today.
Thank you very much. I really enjoyed it.
So that's it for our latest Insider interview. Hope you've enjoyed it. You can let us know what you think, you can comment, and for more videos in the series, do hit that subscribe button. And hopefully, I'll see you again next time.